Hi, hello. This is Robin Lin, and welcome to Zoom Out with Toads It Says. This is part one of our Q3 2023 outlook. What happened in the first half of 2023? So, jumping in, of course, disclaimers. Don't take this as investment advice. Remember, I'm biased. I have blind spots. This is for your entertainment only. This is not investment advice. All right, let's jump right in. What happened in H1 2023? Let's start with stocks. What you'll see here is a chart of the Magnificent Seven, the Facebook, Amazon's, Apples of the world. They did extremely well in the first half of 2023, but compared to the other remaining 493, the other 493 didn't really do anything. So the incredible pull of these seven stocks generated an S&P 500 index average climb of up to around 10%. So looking at the same thing just in a different way, these 7+ stocks have driven the entire stock market. If you were invested in these stocks, you did great. If you weren't invested in those stocks, you just kind of went sideways. So reflecting back on my original outlook for 2023, I didn't expect the stock market to do very well at all. I expected it, earnings recession, real recession, et cetera, et cetera. And what happened really was that the AI craze just blew up. We started hearing about ChatGPT, the excitement, the potential, the productivity boost of what that would mean for the US and its economy, really took the imagination of the entire market. And as a result of that, these AI oriented stocks all drove the market incredibly high. And really wasn't until about July that other stocks started to participate a little bit in this rally. Okay. Just to give context, this is the NASDAQ 100. It's never climbed this hard, this fast, ever. So there really is a little bit of the AI craze that drove the market, but it's very an unhealthy way for the market to outperform, because basically only a handful of companies have been driving the market, resulting in the lowest participation rate of stocks that are doing well. If we just, for context, think back to 2 or 3 years ago, if you had bought and held the S&P 500, let's say in 2021, you would have declined significantly, which we saw a huge, 20% market correction in stocks. And then you've rebounded, which has been this year's exciting stock market. But net, you would still be in a losing position. As you can see, this line is a downward sloping line. We had a phenomenal rally this year, but net, you really actually didn't outperform where you really were. When we break that down further into individual stocks, you can see for Apple, it's pretty much just flatlined. It's Microsoft flatlined, Google flatlined. All of these are all slightly down now. The only one that really actually did outperform was NVIDIA, which makes sense. They are the key chip of everything AI that drives those AI servers, and their prospects are still outstanding. So net, you would have just done better holding NVIDIA, whereas everything else, you were actually still slightly down. Okay. Now, getting into the economy, a couple of highlights of what's happened in 2023 so far. Just to recap, mortgage rates are now above 7%. Credit card debt has exceeded $1 trillion for the first time ever. We had the Silicon Valley bank implosions, big, huge bank collapses earlier this year. The Fed has kept raising rates at the fastest rate it's ever raised. We're now around 5.5% on the federal rate. That means your prime interest rate is around 8. You have to add 3 to that. The debt ceiling crisis came and went, but with the debt ceiling crisis resolution, we also have other consequences from that. One of those is that the interest expense on US debt has crossed over to $1 trillion. So what does that mean? It means the US government doesn't have enough money. It sells treasury bonds to borrow that money, and it has to pay an interest rate on that. Well, that interest rate that the government has to owe and pay has exceeded $1 trillion now. And with all those factors in mind, the United States as a country got downgraded by one of the credit rating agencies. And given all of this excitement and everything, you would think that the market would be down, but obviously the market has been actually up for 2023 so far. So to give a little bit more detail, the rating agencies in the world are Fitch, Standards and Poor's, and Moody's. Moody's has kept the US at AAA quality, but Standards and Poor's lowered the quality of the US, I think in 2012, 2011, something like that. And Fitch just did it this last July. So a weird thing, net for the real world, it doesn't really make an impact on how the world functions. Especially in the US, they changed the banking rules and basically said, as long as you hold AAA quality or sovereign debt, which includes US treasuries, those are counted at par. So it doesn't have an impact on how people buy and sell US treasuries, but it's not a good trend. As I had forecasted, bankruptcies are going to rise, and they continue to rise. We're already in 23 halfway through, much greater than the last couple of years, and we'll see how the last half of this year turns out. But bankruptcies have been rolling up with rising interest rates and a slowing economy. There is a massive spending crash that is coming. The government had suspended student loan payments, but that has been denied and they cannot continue to suspend it. So that is all going to restart September 1st. And there's up to $1.5 trillion of student loans that were paused that have to be restarted beginning this fall. That could mean some bad things depending on each individual student borrower. They may not have saved up money, or they're scrambling, or maybe they are going to tap into their credit cards, or stocks, or maybe home equity. Essentially, what this means is there's going to be less consumer spending, I believe, coming forward as the people start repaying their debts. The inflation rate, we hit a peak of around 9% last year. It's come down significantly, but now it's floating around the 4% range, the broad CPI inflation rate, and it seems to have kind of rebounded a little bit in July. So we need to watch this to see if this is a short-term hiccup or if it continues to rebound. And I suspect that that rebound, at least I believe it'll at least go sideways and possibly start to rebound again. So watch the inflation ratings. And net, this is part of the reason why Fitch has downgraded the United States. Our budget deficit is just blowing up again. We crossed that $1 trillion mark. We had a blowout couple of years, and then COVID happened. We really spent a lot of money to help fight COVID and the economic impacts. That boosted some of the tax revenues of, when your stocks make money, you have to pay taxes on them, and then that boosts the treasury's funds. But we've had the debt ceiling issue, and now we're back down to a $2 trillion budget deficit in the US. Forecasts are for that to maybe continue to go higher and higher, these budget deficits. Okay. Now, what happened in the rest of the world in the first half of the year? Central banks of the world are still mostly red, which means there's still monetary tightening. But you're starting to see signs of green shoots popping up here and there. And it will probably be another quarter, but I think by the end of the year, the red is going to turn to yellow, and green is going to get more green. Generally, for the entire world, we're seeing a trade recession. So exports around the world are starting to fall. We see Europe has essentially already fallen into recession. Germany is probably of the worst, and their just property sector in Germany is just collapsed. We're seeing this in Latin America and Peru and Colombia. There are many, many more other charts that I didn't put together, but there's a lot of stress globally. I think aside from Brazil, South America is falling slower. And probably only Southeast Asia is still doing okay. One of the bees is obviously China, and we're seeing a lot of news recently, last few days, of some bad things happening in China. Their property sector has been the foundation for all the other financing and growth. They're really having some serious issues in China with that. Okay, so that's something definitely that we need to watch. Aside from that, the climate has been very, very volatile. We're seeing record heat all over the world. I don't know if you guys remember, but last year in January, there was a massive volcano in Tonga. It was an underwater volcano that blew up, not above the ground volcano. So for the climatologists, this is what I've been understanding. I'm not a climatologist. Don't accept my opinions as anything scientific. But when above the ground volcanoes blow, they throw up a lot of sulfur into the air, and that generally has a global cooling effect. However, this Tonga volcano was underwater, and it basically blew up and threw up steam up into the climate, which has a heating effect. And given that, possibly with the El Nino transition, which generally means higher ocean temperatures, we've had extremely weird, hot, volatile weather so far this year. As a reference, El Nino years tend to have these type of patterns. You see a lot of dryness in Southeast Asia, India, Pakistan, parts of China, and then you get extreme rains and flooding in other parts. And basically this year for the US, we should have a lot more wetness in California specifically. But we've also experienced a lot of dry heat in the Midwest, which is relevant because that's where all the crops are grown. Similarly, in Latin America, we see definitely some strange weather patterns occurring over there as well. Okay. This was a shock when I saw this news that the Panama Canal, the water levels are so low that they're having trouble having ships get through. That's quite surprising, and it's part of this global climate change that's going on. So I'm going to leave it here for what's happened so far. Join me for part 2 of the what's ahead in Q3 2023. Thanks.